A market crash or correction might be coming very soon. The flags are there, the signs are there, but here's why this might happen and what I'm doing about it. Hey guys, welcome back to the Value Investor Show. Today I'm diving into some financial data. Some of it is very alarming, some not so alarming, and together we will find out whether a crash is really coming or if it's just overhyped fear. Then I will break down Ray Dalio, probably the most successful hedge fund manager in the world, his biggest warnings about the future and exactly why he said them. Then I will compare the AI era with the dot-com bubble. The similarities actually might shock you. And finally, I will share what comes next and how I'm positioning my portfolio. As always, thank you so much for the support. It really means the world to me. I spend a huge amount of time putting those videos together for free. So if you can subscribe, it would mean a lot. Right now, only about 30% of you watching my videos are actually subscribed. So even if 1 in 5 of you hit that button right now, I could hit my 3,000 subscriber goal by the end of next week. So if you're watching this video and you're not subscribed, please subscribe. It really goes a long way, especially given that I spend so much time and so much effort putting those free videos for you together. Gold prices are surging. They have been climbing for a while, but especially over the last year, they're up 40% the last year. But the question is why? And the reason is people want safety, they want diversification, and they want to hedge against any potential upcoming crash or correction. Traditionally, when gold prices go at all-time highs, this is a classic example of sign of fear and not optimism. It happened during the Great Recession, it happened after the 1975 crash, but it's not always a clear cut because even during the dot-com bubble, gold was at an all-time low. So yes, gold does mean fear, but it's not a perfect indicator. And even Ray Dalio, who we will come back to later, has said many times that gold helps him diversify and hedge, especially when things go really, really badly. But the picture might be a bit different. There's a lot of talk about how overvalued the market is right now. Mega cap companies are trading at sky-high P/E ratios, but here is the interesting part. The data shows something different. Even though there is a lot of talk about how rich the market is right now, it's not the entire market. If we look at the average P/E ratio of the firms in the S&P 500, there is a stark difference. Mega cap companies, so companies with larger than 500 billion in market cap, trade at an average of a 31 P/E ratio. Now, if we compare that to the smaller companies in the S&P 500, which is trading at 25 billion or less, they are trading at 17 P/E ratio on average. And that's a very huge gap, and it's something that I have seen myself in my portfolio. Many small caps that I own are still growing at double digits. They have healthy balance sheets, they have great income statements, yet they trade nowhere near the multiples of, for example, Amazon, of Google, of Nvidia, and there is a major disconnect between this narrative and the reality. But the S&P 500 is on a roll. It's up 13% year to date, and remember what happened back in April. I will never forget, everyone was screaming, this is the end of globalization, this is the end of the stock market, and yet here we are at almost all-time highs right now. We're up 13% year to date and more than 30% from the April lows. But yesterday the markets dropped after Jerome Powell warned that the stocks are highly valued. He said, we do look at overall financial conditions and we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve. But you're right, by many measures. For example, equity prices are fairly high valued. And that remark itself drove the S&P 500 down 0.5% yesterday, with some individual stocks falling 3 to 4% and even higher. Investors took this as a signal that the Fed may be reluctant to cut rates and if they think the market is overheated. Which brings me to Ray Dalio. For those that don't know, Ray Dalio is a billionaire and is regarded as one of the best and most successful hedge managers in the world. Ray Dalio has said that the world is running out of interest in buying US debt, but the US cannot stop spending. At the Future China Global Forum yesterday, Dalio warned that America's $38 trillion debt poses a serious crisis risk. And not only that, there is a growing gap between spending for the United States and revenue, which leaves markets very cautious in terms of not only long-term sustainability, but long-term stability for their bonds, for the debt, and generally for the ability to service that debt. But here's the dilemma. If the US cuts spending, then it risks causing a crash. If they don't cut spending, then the debt keeps rising. So either path is very dangerous, and it does require a lot of cautious, and with the market being quite overheated, that is not helping either. And I have been recently reading Ray Dalio's book on how countries go broke and the big cycle, and I wanted to flag the 4 stages that Ray Dalio talks about of the big debt cycle, so that you guys don't have to read the book, so I can help you with what he is suggesting. Now, the 4 stages are this. The first one is the sound money stage, which is essentially means that the countries have low debt and there is high competitiveness in the market. The second stage is the debt bubble stage, which is where debt and investment growth are greater than can be serviced from the income produced. It eventually produces a bubble that is reflected in the rates of debt and debt service growth to finance speculation being greater than the income growth rates that are needed to service the debt. In this stage, markets and economies seem great, with everyone believing that it will get better, and they are financed by a lot of borrowing and wealth that is created out of nothing. I cannot help but notice so many similarities with the current situation. Debt is out of control. Everyone believes that the current market will go better. Everyone believes that the stock market will go up and up and up. And for many companies, wealth is being created out of nothing. There's so many AI companies that are yet to be profitable, and yet they're raising billions of dollars out of thin air. And not only that, many times headlines, which we'll talk about in a few minutes, headlines are driving up market caps of some companies like never seen before. And that leads us to a very dangerous case, a very dangerous scenario for Ray Dalio, which is the top stage, which is where the bubble pops. The economy contracts, the market contracts, and this occurs due to a combination of tightening of money and the prior rate of debt growth being unsustainable. Which brings us to the final stage, which is the deleveraging stage, which is where there is a painful bringing down of debt and debt service levels to be in line with income levels. I'm not saying that Ray Dalio is right or wrong in this case, but I do believe that it's important to flag what one of the most successful hedge managers in the world is suggesting based on his decades of studying the stock market and history. He could be right or he could be wrong, but at the same time, it's important to understand where he comes from and why he's saying what he's saying. And to Ray Dalio's point, the US government debt to GDP ratio was approximately 121% as of 2025, which is at the highest levels it has ever been. But economists aren't really concerned about the amount of the debt, but more about the debt to GDP ratio, because also to Ray Dalio's point, as I said, if the country is borrowing at a rate which outpaces its growth, then investors will begin to question not only the security of the debt that they're holding, but also the ability of that country to pay back, to service that debt to investors. And that makes investing into, for example, the US less attractive for investors due to the risk reward. My opinion is that there could be a correction in the next few months, and I'll tell you exactly why. The S&P 500 historically has seen small pullbacks of 3% every 1.5 to 2 months in average. And it's been well over 3 months since April, since May, where we have seen an actual pullback for the stock market. The S&P 500 also sometimes see larger pullbacks of 5% or more that occur every 3 to 4 months. And again, we haven't seen any correction over in the last 4 or 5 months. We have seen a very good bull run, and which is why I think that over the next few months, we could see a correction. It could be a small correction, it could be a big correction, but I do believe that we will see some kind of correction. And I think there are 4 main levers that could cause that correction. The first one is if we see any impact on the economy because of tariffs. The second one being that if we see any soft jobs data or any other soft economic data. The third one being if the Fed decides to hold on rates, maybe because of some other external reasons or because of inflation. And the fourth one is if otherwise we see respectable tech earnings colliding with the current higher bar and higher valuation. So if we see tech companies reporting their Q3 earnings at levels which are respectable but aren't that great, I think that could cause a big correction in the market. But with everything said, the odds of a recession are actually going down. If we look at Kalshi, the odds of a recession were roughly 70% in April. Everyone thought that there was a recession coming, but now it's currently at 5%. Even this graph right here taken from Apollo is showing that the recession probability over the 12 months ahead is actually declining. Less people actually think that there is a recession going to happen in the next 12 months. But to be honest, I never really take these opinions into consideration. It's just something to flag for people to understand of where the current confidence is. Another thing that I wanted to flag is valuations. Valuations are getting crazy. Just like Opendoor, there are many other companies, but for example, Opendoor is up 7 times in the last 6 months just because the co-founders joined the board and there was a leadership shakeup bringing a former Shopify COO, which has driven the stock into crazy gains. And there are many, many more other companies that are up 3, 4, 5 times in a matter of weeks, not just based on fundamentals. Intel is another company which is up 45% because of a recent $5 billion investment by Nvidia and because of investments by the US government. So again, nothing financially changed for this company, but because of the headlines are driving enormous gains for the stock of this company. And this is a trend that I have been seeing in the market overall. There are many moves in the current stock market that are driven by headlines and not by fundamentally driven moves, which I think is a big red flag for the current stock market. But regardless of that, I'm staying disciplined. Yes, I'm still buying, but I'm buying very selectively. I doubled my Amazon position yesterday. It was down 10% in a month, and I think that Amazon could become the first 1 trillion in revenue company in the world. And I think many people are not understanding yet how margins will expand dramatically for this company due to AI, due to automation, and due to robotics. And I think that Amazon is the best well-diversified company in the world with AWS, the cloud, the ad business, the e-commerce business. I think Amazon is a beast and is not correctly priced. I think it's currently mispriced at 2.3 trillion valuation. But overall, I'm building my cash position. I'm 20% in cash, I'm 20% in real estate, and I'm 60% in the stock market. I'm building my cash position because I do think that we will see a 5 to 10% correction in the coming months, and I am in the lookout for big opportunities when this correction happens. There's some stocks in particular that I'm currently looking at, like Deckers Brands, On Running, Amazon, Adobe, and I will reveal my full watch list in my next video. So if you're not subscribed, subscribe right now. But I think that there will be an opportunity in the coming months to buy more stocks, to buy more companies at decent valuation, at the fairly valued valuations. And in the next video, I will share exactly what my watch list is. But if you're not subscribed, again, please subscribe. I will reveal my full portfolio at 10,000 subscribers. Year to date, I'm 25% up. My goal has been to be as close as I can to super investors, and this year I have been beating quite a few of them. My dream is to, for as many years as I can, be in this list to as close as I can. So thanks for watching, and I'll see you at the next one.